Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you actionable insight so that you can make your investments into mutual funds with confidence. Now, there's something of it's a statement that is made quite often about large cap actively managed funds. And in case you're not familiar with the distinction between active and passive funds, it's essentially an active fund is where there is a fund manager that decides on the portfolio of stocks that a scheme invests in. Whereas a passive strategy would simply mirror a benchmark, something like a Nifty 50 index fund. Now, the statement that I was referring to is that actively managed large cap fund managers don't manage to beat the benchmark very often. And it doesn't make sense to go whole hog and invest in these schemes. Instead, a lot of people say, a lot of advisors say that you're better off investing in passive funds because the cost involved is significantly lower. But the thing about it is that over the last 12 months or so, most actively managed large cap funds have managed to beat the benchmark and by quite a large margin. What are the factors that contributed to this? And does this mean that you should change the approach that you might have been following where you are investing in passive large cap mutual funds? Joining me to talk about this in more detail, I've got Santosh Joseph, the founder of Germinate Investor Services, and Nikhil Kothari, director of Etica Wealth. Thank you so much to the both of you for taking the time. It's quite an interesting subject because I would think that a lot of these fund managers would have felt quite hard done by with the kind of criticism that they've had to face over the past several years. But it's been a great 12 months for them. Santosh, first to you, what are the factors, according to you, that have led to the outperformance and quite a degree of outperformance at that?
To begin with, I think it's a huge relief for the people who believed in the active managed large cap space. And it's an interesting time right now to look back and say, they were not wrong. And for many of us who were thinking that passive was the only way to look at large cap, I think it's proven that good active managed funds, have come back and have come back really well. Now, I think there are more reasons than just one that has led to this. One is that in the last 2 to 3 years, the large cap as a space was getting reasonably, and from a valuation perspective, more reasonable. It became a point where investors found a lot of value there. Second is that I think fund managers over the last 2 to 3 years understood that, the skew that was present in the index was slowly reducing. And therefore, there was an option for them to really, prove how active large cap funds could perform. Now, not to forget that large caps are a lot more stable, and therefore you have a lot more legroom to do some good work there. And the mean reversion between the market caps also helped. A combination of all these factors has brought the whole active large cap space back in action. And it's a great time for large cap investing, both from a valuation perspective, both from even the way one wants to take a call today on the market. It's a great opportunity.
And just to point out the degree of outperformance, we're talking about 20 plus out of the 30, 21 out of the 30 actively managed large cap schemes that have outperformed over the last 12 months. And on top of the list, if we can pull up that, in fact, let's talk about which schemes have outperformed. GM large cap to the extent of 14.3% outperformance, percentage points, I should say. Quant large cap fund as much as 12.5 percentage points. Bank of India blue chip fund, Baroda BNP Paribas large cap fund, and Nippon India, something of a common name in that top 5. It has more or less been in that ranking for quite a while. But Nikhil, you want to add to what Santosh has already talked about? Usually when we're talking about the degree of outperformance in large cap actively managed schemes, they're not to the extent of 14 plus percentage points, right?
There's a couple of factors what lead to outperformance. So whenever you have so what are the index large cap heavyweights? You have Reliance, you have HDFC Bank, you have TCS. Now, if you look at last 1 year performance, TCS has been underperformance to the Nifty. HDFC Bank has rather it's a negative return over last 1 year. So whenever there is an index heavyweight, okay, underperforms and when the narrow index heavyweight underperforms the large cap index, the fund manager has a liberty to buy stocks across the band. And whenever there's not a narrow rally, when it's a broad-based rally, the active managed fund will be able to outperform the index. Okay, so the reason primarily was that a lot of the heavyweights underperformed the index, and fund were able to outperform because they have a broad-based. They're not limited to few stocks. They have a broad-based rally. Second thing is that in last 1 year, mid cap and small cap has outperformed substantially as compared to large cap. So when you're talking about few of the funds when they've outperformed substantially, the reason is that in a large cap fund manager is supposed to have at minimum 80% large cap, and he has some leeway to get in some mid cap and small cap stocks also. So wherever some fund managers has able to take some part of, like, not a substantial part, but even if a small part of the exposure in mid cap names or beyond not Nifty top 100, then the outperformance the alpha generated by that particular stock lead to overall outperformance. So considering that this will be a normal norm, I won't agree to that, because whenever the rally is a broad base, active managed fund would be able to outperform. But whenever the rally is narrow based, like if you look at last 1 month, okay, most of the active managed funds have underperformed the index, because in last 1 month, Reliance, HDFC Bank, both have, and TCS all have given a better return than the index. So if you look at last 1 month, active managed fund will underperform the large cap. So this story will keep on changing every now and then, but predominantly the last 1 year has been broad-based rally. Mid cap and small cap have outperformed the large cap, and that's why you see substantial outperformance over the index.
Okay, just an add-on to that, and maybe, gentlemen, we can speak about the stocks that these individual funds have bought and sold as well, and bought in particular, because my colleague has done a very interesting piece. It's available on the website, and the headline is, and I'm reading this out, these stocks led large cap funds outperformance last year. And we've looked at the 5 top performing large cap schemes, and we looked at the commonalities in the portfolios, right? So you have HDFC Bank, which is held by all 5 of those top performing, and I read out that list of schemes, right? You have ICICI Bank that is also held by all 5, and NTPC, which is held by all 5. Incidentally, the 1-year return of ICICI Bank is 29.5%. NTPC has returned nearly 95%. It's a doubler. So all of these schemes holding NTPC have benefited quite significantly. And then you have the likes of State Bank of India, which has gained about 47%, which is held by 4 of those schemes. You have Larsen & Toubro, which is up about 42%. And you also have Reliance Industries, which, by the way, has gained about 35% in the last 1 year. So what about the churn? Because out of the 5 schemes that we're talking about, Santosh, Quant is the only one that historically churns quite a bit and has churned. But something like a Nippon India has the lowest churn, but it has managed an outperformance still. So it's not really about the churn.
So Alex, it's a good point that you just mentioned now over the performance of the stocks in itself. So that leads us to 2 very important categories. Number 1, active deselection. Now, if you actively from the index deselected a particular stock that was a part of the index but not a part of large cap, your chance to do well. Second was active weight management. Now, this is where we'll answer your question over here, whether it's Quant or Nippon, whether there's churn or no churn, the weights really mattered. For that matter, if you reduce the weight of the stock from the index to the fund, thereby increasing the weight of the other stocks which are less on the index but high on your fund, straight away you had scope for performance coming into the portfolio. So I think Quant has taken the approach of active churn, whereas Nippon has taken the concept of active weight management by deselection of the stock. A classic example, ICICI Bank versus HDFC Bank. Both are large private sector bank. ICICI, as your numbers showed, was 0.02. Sorry, HDFC was 0.02. ICICI was in a good double-digit return. So having ICICI over HDFC was straight away giving you an edge to outperform. Likewise, NTPC and Axis Bank, the numbers are showing on your screen. It was an easy call if you just chose the right stock within the large cap index.
Point. All right. So why don't you take that forward, Nikhil? Do you have something to say about the underlying? Because PSUs as a theme has played out quite significantly. NTPC, I was mentioning, 95% return, and the top 5 all hold it.
Yeah, so see, as Santosh rightly said, so now from the fund manager perspective, they need to keep on actively managing the weight across the stocks and the sectors. Now, PSU has rallied quite a lot, and so in that way, fund manager has I'm saying from a valuation perspective, they're slightly expensive as compared to the historical averages. So fund manager need to moderate the exposure incrementally and then start looking at stocks which is not perform. So if you look at, as I discussed in last 1 month, HDFC Bank, TCS, Infosys, all has given very good return as compared to the broader index. So that's again to continue the outperformance. Fund manager would have changed the allocation from the good performing stocks in last 1 year to now the stock which is not performed, and they've changed the weight allocation accordingly. If they've done that, then the outperformance will continue over a period of time.
Okay. Okay, I was going to come to that question, Nikhil, and I'm glad that you pointed that out, if they do this. But Santosh, in the past, if we look at the rolling returns over the long period of time, then what we've seen over the last year, that argument kind of evaporates, right? It's not something that we've seen consistently. So therefore, is this outperformance likely to continue based on what you're seeing right now?
So Alex, you're right. When you look at a 10-year base of returns, of rolling returns, and even a 10-year point-to-point return, the large cap funds are still very closer to the index, and therefore the argument of passive, low cost all comes into play. But let's, for a moment, stop and pause and say, why are we doing large caps? We do large caps because we want stability in the portfolio. We want to access that bit of the market, even though sometimes the performance may be weak. You cannot miss or escape the largest companies in the stock market. The third part is, if you are someone who's going to be in large cap for a long period of time, then there are better ways to manage the whole large cap through, let's say, a flexi cap or multi cap than a standalone large cap. That is, if you're going to be a really, really long-term investor. The numbers actually for the last 1 or 2 years are in favor of large cap active funds, which I think there's reason to believe that it could even be extrapolated for a few more years to come. But the answer lies in what is your requirement of being in large cap funds. Don't mix the outperformance that we are seeing right now with the need to be in large cap funds. I think large caps are integral to any portfolio. They add stability. They add a lot of purpose to investing in these large cap funds. So I still believe that active large caps, whether you do it through a large cap fund alone or a multi-cap stroke flexi cap fund, it's an integral part. You can't miss it out. This short-term outperformances are something that you enjoy over the course of time, but you don't miss out the large cap performance. In fact, if you look at flexi cap, on average, most flexi cap funds are 60 to 75% large cap, and even there the performance has been brilliant.
In fact, I was going to come to that question. Why don't I ask Nikhil what he thinks about this? Because a lot of people buy flexi cap because of the no restriction on 80%. That threshold is not there. But it still tends to be more large cap, as Santosh has pointed out. So why don't you hold that? And I would hazard a guess and say, I haven't looked at the numbers, but I'm quite sure that quite a lot of flexi caps have beaten even what the large caps have had to offer, right? So why not buy flexi cap?
Yeah, so from a individual investor's perspective, I'm thinking flexi cap makes better sense than a pure large cap fund, because the fund manager will have a liberty to add some mid cap and small cap in the overall portfolio, but still there still be biased towards large cap. So from a recommendation perspective, I'll say flexi cap and multi cap funds make a better sense as compared to buying pure large cap. But if someone wants to buy pure large cap, then I'll say he should have a combination of passive as well as the active funds. So he can have a core part of your pure large cap in passive and one active funds in the portfolio. But otherwise, from a retail investor's perspective, they should either opt for flexi cap or a multi cap, because they will have exposure across large cap, mid cap, and small cap.
Okay, that's a fair point, because again, that was going to be a question that I was going to ask, which is the passive strategy. That doesn't change, right? So, Santosh, would you still prefer going, in the ordinary? And I'm not talking about what individual investors should do. Everybody takes their own call. But if you were to advise somebody and somebody comes and says, Santosh, look, there's been a significant outperformance for actively managed. Should I change the strategy that I've had, which is to invest in low cost, large cap passive funds? Should I do that? And second, if you are advising somebody about a passive strategy, would you say go for Nifty 50, which is what most people do? But is that enough? Because ultimately, if you study the benchmark that most of these actively managed funds operate on, it's not the Nifty 50, it's the NSE 100. It's the benchmark that has 100 stocks.
The Nifty 100. So you're right, Alex. It's a very good question. For people, this becomes the most easiest part to solve, because you want large cap exposure. We just spoke that large cap exposure also can be achieved through flexi cap. Now, for the people who are in active versus passive, I think you have a great case going here to have both a combination of passive and a combination of active large cap exposure. It's not one or the other. It's not that I'll just shift right now because there is a case of outperformance. But I think the minute you know that you want to have a good bedrock of a large cap into your portfolio, a combination together will work even better. Let's take a classic example. Just the last 1 year or 2 year, if you had a combination of both the active and the passive, you got the best of both worlds. Why do you have to just choose and then worry about should I move from active to passive? And you can have both in that space and benefit from both. So taking an example over here, between the index and the large cap, the combination would have given you maybe 5 to 10% absolute better return than just going on any one strategy.
Yeah, that's a fair point. All right, gentlemen, we have to slip into a very quick break, but there are a few viewer queries that have come through. And by the way, I would like to pull that up on the screen if we can, the WhatsApp number that we've got, so that you can send your questions there. There you go, it's flashing on your screen. If you've got questions related to mutual funds, then I would invite you to send them to us on that number and we'll take them up. If not today, then over the course of this show, which is live every market day apart from Friday at 1:30. We've had quite an engaging conversation about the outperformance of actively managed large cap schemes over the course of the last 12 months. We've spoken about the reasons why that took place, and we've also spoken about what your strategy should ideally be. Now, we have invited you to send us your queries, and some of you have, in fact, sent your queries. And I'm going to take the first one from Pragyan. Pragyan is 45 years old. And incidentally, he's speaking about the topic that we discussed today. He's asking what are some of the best large cap funds that can work well in the long run. And I hope that Pragyan has watched the rest of this show, where both our experts have said that if you are venturing into the large cap space, the best approach would likely be to have a combination of active and passive. So to that end, Nikhil, what should the approach be here?
It will be a combination of passive as well as active. So I'll say from a passive fund, you can look at Nifty 100 as a one index, or you can look at Nifty large cap momentum index also. And with that, you can add one active fund, which maybe say DSP top 100. So the combination of a large cap active managed fund as well as the index fund should make a good sense on the long term perspective.
And just to follow up, and this is my own question, I wanted to ask this earlier, but it slipped my mind. Santosh, so we have spoken specifically about the category of large cap, but then if we talk about outperformance of the broader markets and therefore the outperformance of mid cap and small cap, and if somebody has seen their portfolio skew, based on what you've seen tactically, would you shift some out of the broader market funds into large caps? Because that's ultimately what I think a few fund managers have also started talking about and have done over the last few months.
So the part is how much do you want to move out? Because even though it's a large cap fund, and Nikhil alluded to this a little earlier, you do have that 15-20% leeway to be in the broader market. But if your portfolio's got a completely different mix in the last year or so, right now I think is a great time to readjust that and rebalance it. And see, another merit that we have whenever the markets keep moving like this and creating a dispersion in terms of return is always use the opportunities that the market presents to readjust your portfolio, rebalance your portfolio. So therefore, if you're too much into the mid cap and the small cap and you'd like to get this auto course correction, it's a great time right now to do it. And therefore, the most important aspect of this rebalance that you will do is to keep your portfolio in good shape, even as the markets keep dynamically moving.
Speaking of opportunities, we have two funds which have opportunities in them. Asta has got this question. She's 25 years old and she's looking at two thematic funds, SBI Automotive Opportunities Fund and SBI Consumption Opportunities Fund. As the name suggests, one relates to the automotive sector, and the scheme ultimately is trying to benefit from the prospects of the automotive sector in India, which, as you know, is a growing market. And the Consumption Opportunities Fund, as the name suggests, is looking at utilizing the theme that has been playing out in India. Of course, in the recent past, consumption has not done too well, but it is talking about per capita growing, etc., etc. What should you do if you're talking about this? I believe this is Asta's query. That is right. So, Santosh, what's the view here?
So, Asta, considering your age and your obvious choice to pick up the most flavored thematic fund of the period, which is SBI Automotive and even the SBI Consumption Fund, please remember that if you're going to invest in this fund, you're getting into a thematic exposure, and therefore you have to have really a long-term perspective. Now, in some case that you want to begin with these funds, you might as well could go ahead, but please remember avoid only thematic or sectoral funds because though these may do very well in the medium to short term, there will be cycles that these funds will go through. It's always better to build a diversified, a multi-cap to flexi-cap strategy to build your portfolio, especially since you're starting young. There's nothing wrong with this, but remember, a diversified portfolio will help you navigate the market cycles way better than just the a flavor of the season or the most opportunistic fund for the given moment.
Okay, that's a fair point. Would you say, so there are some people that have said that you can stretch your thematic allocation, not sectoral, thematic allocation to up to 20% of equity. Is that too much according to you, or do you think it's fine if you're well diversified?
So that's fine because today it's not sectoral but thematic, and each team has got multiple sectors playing in that. Today we've realized that every team that the fund is representing has actually got a 200, 250, sometimes even 300 stocks in the universe. So it's not a skew. But also remember, it's still a theme. So if you add 5, 6 good dominant teams, maybe you're as good as a diversified fund. But the fact is, your opportunities play better in a diversified fund than in a thematic.
That's a fair point. The next question is from Reema Singh, who is aged 30. Wants to invest a bulk amount or lump sum of 1 lakh rupees and was considering the Quant Small Cap Fund direct plan, not looking to diversify and targeting return of 30% over a year. I mean, there's a lot that can be said about this, Nikhil, but what advice would you give?
See, my only concern in this whole query is the return expectation, and which is 30%. So your return expectation is completely biased towards what has happened in last 1.5 years, right? So people should be very aware of it that markets goes through cycle. In the last 1.5 years has been amazing for Indian equity market. You may have a consolidation phase also. You may have a periods when there would be no return for next 2-3 years also. So what investors should be aware that over a long period of time, what you can expect from market is 12 to 15% year on year. And 30% is too high expectation from the market, right? The small cap funds have done reasonably well in last 2 years, but right now their valuations are slightly stretched. So investing lump sum money in the small cap, you have to have a minimum horizon of 5 years, and return expectation has to tone down to 12 to 15% and not 30%. If you are fine with 5-year horizon and return expectation of 15%, then you can well go ahead and invest in this fund. But if your return expectation is 30%, I'll say you may get 30% or you may make negative return also. Be aware of that.
Yeah, broaden your time horizon. The last question is a very interesting one, purely because of the quantum that is involved. And this one's for you, Santosh. We got Brijesh Patel at the young age of 33. He's got 5 crore to invest over the next 5 years. And he's expecting 24 to 26% returns over that period. I'm assuming this is not point to point. He's talking about annual returns. And he's asking what the best course of action is. Should he invest in mutual funds or stocks or both?
So, Mr. Brijesh, this is it almost looks like a WhatsApp forward where people promise you high returns. And so my advice to you is please have a realistic expectation. Markets have been very rewarding to investors and these kind of returns have been made. But to go into an investment with a medium to small term time frame like yours, which is 5 years, and with a large capital like 5 crores, I would advise caution. Please be careful. Both 5 years and 24 to 26% is not practical, especially for equities. Equities are an asset class for a really long time. There have been instances in the past where in 2 to 5 years you have made this kind of money, but that's not going to be always sustainable. So please be realistic, tone down your expectations, increase your investment horizon. Your investment amount seems good. So therefore, if you are able to be realistic, increase your time horizon and also drop your return expectation, you might as well enjoy these returns if it comes, but don't go for just that as a target.
Yeah, that's a fair point. By the way, 24%, you would double your money in 3 years' time. And that's something that most people would be happy with. Santosh, Nikhil, thank you so much.
We wish it would be that way.
Thank you so much for taking the time, and pleasure speaking with you as always. This was the Mutual Fund Show. Thank you so much for tuning in, and do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.